Hi, everyone. This is chapter 15. This is the financial sector, and this is the last chapter in unit or strand 4. So it's kind of looking at the banking system, interest rates, the whole lot, how banks work, etc., etc. So we'll kick straight off into it. There'll probably be 3 videos, I would say, on this. We'll see how much I can get done today. As you know, I have a tendency to talk. Such is life. So the financial sector is really looking at banks, and there's a load of different financial institutions out there. Again, whether it's your credit unions, your post office, your traditional banks, or your merchant banks, your commercial banks, your stockbroking firms, etc. They're all financial institutions, and they're all there to make money for themselves and ideally to make money for you. And really, what the main thing that the banks do is they take your money. They take your money in the form of a deposit, and they take that money and they lend out an excess of that to people who need it, businesses and companies who need it. So, what do banks do? They facilitate you to save and they lend. And then they also do this thing, and depending on the size of the bank, especially these things called merchant banks, is if you want to borrow money on a long term basis, either you want to borrow, and again, we're talking businesses here, bonds or shares, you want to go on the stock market, the banks can facilitate these things. Okay. So they've a multifaceted approach to helping consumers, individuals and businesses. And obviously, depending on who you are, whether you're a business or an individual, there are different things they cannot do. So I'm not going to read all of this. Okay, I'm not going to read all of this. But in essence, banks are really there. Like there's 0% interest rates at the moment. So really, the current role of a bank is to provide lending to businesses, and they can do this in a couple of ways. They can do short-term lending, which we'll look at in a second, or they can do more longer-term lending. They can. Some of you we've done a little bit of a study onto the stock market. So what banks can do is they can facilitate businesses selling a piece of equity onto the market, selling shares, and very popular thing, especially as companies get bigger and bigger. And then there's other things called bonds, and we'll talk about bonds later on. So this is just a quick introduction to it. So in essence, what happens is if if a bank or if a company wants a loan, they can only get a loan if the bank have money. And where did the bank get money from? The banks get money from people who are depositing that money there. Now, how does a bank make money? Well, a bank's making money by paying savers a lower interest rate than they're charging lenders. So if you deposit money into a bank, at the moment you'll get like 0% or maybe 1% if you're very, very lucky, because the interest rates are minuscule at the moment. We'll talk about that, and we've talked about that. But if you want to lend money or if you want to loan money from a bank, you could be paying anything up to 15%. So banks can make that money that way. So they incentivize people to save by giving them an interest, and then they incentivize people to borrow by giving them a multiple of what they could do usually. Okay. The financial sector is the engine of the economy. Up in Dublin, you have, we spoke about, for instance, the 3 things that the Irish state specialises in. We've looked at pharmaceuticals, agriculture, tech industry, but also the financial industry is really, really strong up in Dublin. There's a place there beside the Three Arena, some of you know, where the Three Arena is. And that whole area there on the north side is dominated by the financial services firms. It's called the IFSC, the International Financial Services Centre. I worked there myself for a few years. And then the other side of the river is the kind of tech industry. And the IFSC is critical to the success of the economy because, again, economies revolve around money. And if you have a strong banking sector and a strong financial sector, it will really contribute to any increase in GDP. So there's 3 types of financial markets. 3 types of financial markets. This is important to know this. All right, there's the money markets, the capital markets, and foreign exchange markets. The money market is stuff that you will use. So you, as an individual, as a 16, 15-year-old student, will use it for just day-to-day kind of banking. This is called the money market stuff. And again, companies use this as well. So companies use credit cards and debit cards, and they use deposit accounts, and they use overdrafts, and they use all these sort of things. And these is called kind of short-term debt. Money markets is if you need to borrow money today, but you'll be able to repay it back in a week's time. You'll just go on to a money market. And again, a money market is just borrowing, short-term borrowing. Capital markets is a little bit bigger. Capital markets is where companies need to borrow a huge sum of money. So again, they might decide to expand into a new market, or they might decide to build a new factory, whatever the case may be, and they need a lot of money for this. And if you borrow a lot of money, you're not going to be able to pay it back in 24 hours or a year. So there's 2 things you can do. Number one, you can either issue a bond, which we've spoken about before, which is firms or companies or individuals lending you money for a specified period of time, 3 to 5 to 7 to 10 years, or else you can actually sell a part of your company on the stock market. And banks will facilitate this. And the last thing you can do, which is what banks do, and we'll look at international trade for Fortures, we'll look at international trade next year for Leavenswert, we're looking at this, we've kind of looked at it already. If you want to trade internationally, you may have to buy foreign currency. So if you want to buy pharmaceuticals off a US company, or you want to buy raw materials from China, you have to pay them in their base currency, which means you need to pay them in a different currency. You need to exchange your currency for a different currency, and banks will facilitate this as well. So they're the three main things that banks do. Now, I'm going to go through this really quick, okay, because there's a lot of boring stuff here. So what are the main things that affect everything that we've talked about here? Number one is the rate of interest. If the rate of interest is high, it's good for savers, not good for borrowers. If the rate of interest is low, it's good for borrowers and it's not good for savers, as you can imagine yourself. Rate of interest, ECB sets rate of interest. We've spoken about that before. Number two is expectations. So do people want money? Do people want to borrow money? Do businesses want to borrow money? You'll borrow money if you think you're going to make more money in the future, which means you think the economy is going to do really well. You think your product is going to do really well, or you think this recession or this pandemic is going to continue for another year, perhaps, and which means you might hold off on your expansion plans. So this will decrease the demand for any cash, which again has implications then for the financial sector. The cost of capital, depending on what you want to use this loan for. If you want to use this loan, as I said, for kind of short-term cash, just to bring you over the pandemic, it might be a short-term overdraft you need. Whereas if it's a piece of expansion, new factory, whatever the case may be, you may need to go to different avenues. So again, you may need to go to the capital markets, and that complicates things as well. It's not as easy to go to the capital market and sell shares for the expansion of your business. It's not as easy to do that. So loads of different things involved. Government policy. And we've spoken about government policy in this course as well. So, what's the government policy towards expansion? How are the government planning and driving their GDP higher? What's the monetary policy on this? Are they trying to curb inflation, which means they need to maybe maintain low interest rates, or they can't really influence the ECB, but certain government policies out there can dictate the amount of cash in the economy. And then two more. Internationally, so what's happening internationally? Is an international pandemic? Is it an international recession? Same thing with future expectations. Is the global trade, is the global trend positive, or is the global trend negative? And at the moment, you can kind of say it's kind of gone positive a little bit, because there's a light at the end of the tunnel with COVID, which means now more companies are going onto the markets to now get back into business and to borrow. And then the last thing is this thing called fintech, financial technology. This has changed. This has dramatically changed the way that finance is operating because of technology, because now you've Apple and Google Wallet and you've all these Revolut things, where it's far easier now to transfer money between two people than it would have been 10 years ago. In fact, and again, you talk about Bitcoin and all these different cryptocurrencies, where you may not need a third party, you may not need a bank for you to get money transferred to you, or for you to raise funding yourself. So the banks may be going the way that the airline that travel agents were. They may be going the way of auctioneers were, where they're kind of unnecessary. They're kind of a third party now that technology is now making obsolete. So this is really important as well. So let's keep going. So how do banks create credit? This is the main kind of concept of this whole chapter. The rest of it was kind of an introduction. How do banks create credit? So how do banks actually operate? And really traditionally, this is the traditional was that if a consumer lodges money into a bank, okay, so if a consumer me or you went into a bank, we had €1,000 or €100 or €1,000,000, the amount is irrelevant really, because you're just looking at the percentage. What the bank had to do was they had to hold a certain percentage of that money. So you go in to your bank with €1,000. The bank by law has to hold perhaps 10%, and this is called the reserve ratio. We'll come to this again. And they're allowed to lend out €900 to consumer B. They're allowed to do that. So if anyone here who's watching this has money in the bank, well, you actually don't have money in the bank, because that money, the money that is put into that bank, is lended out to someone else. You do not have money in your bank. Now, that's the traditional method. It's also the current method. But what's happened here is things have kind of changed slightly in the last few years. So the traditional method is there's €1,000 that retains in the system. They hold €100, they lend out €900, €1,000 is in the system. And that's just the way traditionally banking has worked. But with the advent of technology, really, and the advent of online transactions, this is the current method. The current method is consumer may lodge €1,000 in the bank. Central bank rules state that the reserve ratio is 10%, which we have above as well, 10% reserve ratio. Now this changes. This is quite a complicated calculation. You'll never be asked to work out the reserve ratio or anything like that. Don't be worried about it. But by law, the central bank will tell them how much money they need to keep in reserve, i.e. how much money needs to stay in safe. At the moment, it's close to zero. It really is close to zero. In the United States, it's 10%. Now, what's interesting is the bank basically keeps this €1,000, and it says if we need to keep 10% in deposit, we'll keep that €1,000 on deposit, but that will support potential deposit of 10,000, which means we can lend out 9,000 to consumer B. I'm going to go through that again because this is complicated. Well, it's actually not that complicated. It makes sense, but it doesn't make any sense at all. So if you lodge money into a bank, the bank can then lend out 900% of that amount that you lodge into it, if it's a 10% reserve ratio. Bank, take your €1,000 and they lend out €9,000. Now, you should have an obvious question here right now. You lodge €1,000 into a bank and the bank gives 9,000 to another consumer. The obvious question you should have right now is, where did this €9,000 come from? Read through this again. Consumer A lodges €1,000 in the bank, and the bank says, okay, that €1,000 we can treat that as a 10% reserve ratio. Therefore, we can loan €9,000 to someone else, because 9,000 plus 1,000 is 10,000. Reserve ratio is 10%. That's €1,000. Where does the bank get 9,000 from? Well, the answer is what? Magic. The bank just creates this credit. It creates it. It's just on a spreadsheet. It's just on a computer. They add a few zeros and they send it off. The banks can create money from zero, from nothing, from scratch. Banks can create money from scratch. That's the weird and wonderful thing about the banking system at the moment. Banks can create credit. Now I'll show you then what the implications of this means. So there's loads of stuff here. I'm going to put these links up here. How do banks create money? The central bank reserve requirements here. It is as simple as I said. It is as simple as they literally just take a spreadsheet and money goes out. Remember, most money is not physical. We'll look at this in a second. Most money is not physical. And money's not physical. It's just a number on a screen. That's all it is. It's all just a number on the screen. So there's a really good thing there. So if the banks just create all this weird money and your money is not in the bank, what happens if you need your money in a bank? So what happens if you need the money that's in a bank? Well, it's not really there. If everyone demands their money back, you'll find very quickly that your money's not there. So this happened about 3 or 4 years. This happened about 10 years ago. There was a company called Northern Rock, banking company, and confidence was shot in Northern Rock. So they're going to sue Northern Rock. It's going to collapse. And everyone started rushing to the branch and saying, I want my money, I want my money, I want my money. And the problem was Northern Rock didn't have your money because your money was been lent out to car loans and to mortgages and everything else under the sun. So Northern Rock, the company, went bust. It went bust because people all demanded their deposits. No deposits there. They only held 10% of deposits, which means hundreds of thousands of people lost their money. Or they would have, except the UK system came in and guaranteed all deposits under 100,000, similar to what they did in Ireland. I'll talk about this at a later date. Really interesting thing. So there's a good story there on bank runs. So how much money is in there in the world? I'm going to finish with this. As of January 31st, there was 1.7 trillion in physical circulation. 1.7 trillion in physical circulation. But that's only in physical circulation, notes and coins and like physical stuff you can see. If you take into account the money that's on deposit in savings accounts, you get to 37 trillion. So again, this is money in the world. This is just converted to US dollars. All the physical money plus all the money in savings and checking accounts and deposit accounts. And again, this is the money that's in your bank account. But again, it's not physical. But if you still add it up, it's 37 trillion. However, if you have broad money, so this is money that's, again, lent out, cryptocurrency, bitcoins, a whole lot, you get 90.4 trillion. But if you actually look in the stock market, look at all these things called investments and derivatives and cryptocurrencies and everything, all these futures and swaps and options, it's actually 1.2 quadrillion. This is what 1.2 quadrillion looks like. That's how much money technically is in the world. 1.2 quadrillion. That's an extraordinary amount of money, but also that's not a true. 1.7 trillion, 1.2 quadrillion. That's a multiple of 10. That's insane. And that's not true because there's no such thing as physical money like that anymore. As a result, the world's debt pile is enormous. 281 trillion. That is enormous.